Hi, my name is Kate, together with Paul, to take you through this chapter. We only appear on this slide, but we'll be talking to you through the whole chapter. To get the best from us, we request for extreme silence and maximum attention. However, if there is anything not clear, please replay the slide or video, as many times as you want. We wish you a good learning session. Chapter Overview 10.1. Money received is on slide 5. 10.2. Daily sales total is on slide 14. 10.3. Sales receipts is on slide 22. 10.4. Fees income is on slide 30. 10.5. Income and sales VAT is on slide 34. 10.6. Recording sales VAT is on slide 40. 10.7. Modified sales VAT account is on slide 47.
10.8. Fixed assets sold is on slide 67. 10.9. Refund received is on slide 70. 10.10. Capital introduced is on slide 76. 10.11. Borrowed money is on slide 79. 10.12. Agency collections is on slide 85. 10.13. Other receipts is on slide 90. 10.14. Balancing accounts is on slide 92.
Section 10.1. Money received. This chapter focuses on how to record source documents for money received, and specifically income received, which are found on the income and receipts file. Before recording, we identify whether it's an income or just a receipt.
An income arises from the sale of goods held for resale, fees for services, or it may be a bank interest. It may be paid for, or it's a credit sale. An income increases the profit of a business. A receipt is any money received by a business, but does not increase its profit. It may come from capital introduced, borrowed money, a fixed asset sale, a purchaser's refund, debtor payment, or other type of receipt.
A fixed asset sale is not an income, since it was not bought for resale. For all received money, a receipt should be written to confirm, and it serves as the source document. An illustration next. Money received is either an income or a receipt. Income comes from the sale of goods. Fees for services or other income. Receipts are for either fixed asset sales. Purchases refund. Capital introduced. Borrowed money. Agency collections. Debtor payments. Or other receipts. The identification of whether it's an income or receipt, what exactly it was, is based on the narration or detailed information on the source document. Please ask in case of doubt.
The next step is identifying the accounts to be credited and debited. The giving account or the source of value is credited, while the receiving or destination account is debited. The narration is generated from the source document. It's either a summary of the information, or an interpretation of what the transaction was. For example, if it's on the sales account and we write cash in the narrations column, it implies it was a cash sale. The final part is copying the date, document number, plus amount, from the source document. Section 10.2. Daily sales total. Many small businesses do not individually record what they sell. Sales for the day are computed by the following procedure. Count the cash at the end of the day, add any payments made during the day, add any banking made, and subtract the opening cash balance at the start of the day. To get the daily sales total. Daily sales totals are recorded in a book or sheet of paper. Since there are no individual receipts, it's the book or sheet of paper, filed on the income and receipts file, that serves as the source document.
Daily sales totals are recorded by crediting the income account, which is the source of the value or products, and debiting the receiving account, which is the destination of the value. The income account should be the sales takings account. This money is often received in cash form, so we debit the cash account. Below is an illustration, recording the daily sales total. Credit the income account, which is the sales takings account. Debit the receiving account, which is the cash account. To credit is to record the amount in the credit column, in this case it's the sales account. To debit is to record the amount in the debit column, in this case it's the cash account. Then generate a narration, and copy the date plus document number. Below is an extract from the daily sales totals for the month of July 2010, these are recorded as illustrated below. They are both credited to the sales account and debited to the cash account. At this stage, you should try this exercise. Start by creating the sales account and cash account, leaving 4 rows to each account.
Section 10.3. Sales Receipts. This is when a sale is made for cash, a check, debit card or credit card payment, and a receipt is issued to the buyer. The retained duplicate copy in the booklet or file serves as the source document. Sales receipts are recorded by crediting the source account, which is sales account. The second entry is made by debiting the destination account, which received the money. Next is an illustration of the possible double entry. Recording for a sales receipt. Credit the income account, which is the sales takings account. Debit the receiving account, which is either the cash account, check receipts account. If the payment was received by cash, then we debit the cash account. If it was received by check, then we debit the check receipts account. We only transfer from the check receipts account when the check has been deposited to a bank, and the stamped deposit slip is the source document. However, if a received check was deposited immediately, then we debit the bank account. If the payment was received by debit or credit card, then we debit the electronic receipts account. We only transfer from this account when we confirm or see the deposit on the bank statement. Below is an illustration of sales receipts. The recording in the ledger should be as follows. This recording is explained on the following slide. For document number 25, the first entry is crediting the sales account, and the second entry is debiting the check receipts account. For document number 26, the first entry is crediting the sales account, and the second entry is debiting the cash account. At this stage, try exercise 10B in your books. Section 10.4. Fees income. Some businesses don't sell goods but charge fees for services they provide. If they get prior or immediate payment, then the mode of recording is the same as a cash sale. A receipt is prepared, which is the source document to be copied from.
The only difference with a fee income is that the credit entry is made on the fees account, which is the source of the value. The debit entry is still made onto the account which received the payment. Next is an illustration of the possible double entry. Recording fees income. Credit the income account, which is the fees charges account. Debit the receiving account, which is either the cash account, check receipts account, bank account, or the electronic receipts account. However, some service businesses prefer to record their main income on the sales account, instead of the fees account, which is not a problem. Section 10.5. Income and Sales VAT. VAT is an abbreviation for value-added tax. It's a percentage that is added to the seller's selling price, and later paid over to the VAT authority. It's an indirect tax collected by the seller on behalf of the government.
It's paid by everybody who buys items that are VAT rated, or items with prices where VAT is added. Some items are VAT exempted, implying no VAT is added. Businesses with an annual turnover above £73,000 in UK are required to register for VAT by law. When a business registers, they start collecting VAT for the government by adding a percentage to their selling price. This is known as sales VAT, or output VAT. The percentage added in UK is 20% of the selling price. In return for collecting VAT, registered businesses claim back the VAT they paid on purchases for the business. This is known as purchases VAT, or input VAT. VAT source documents. In bookkeeping we record VAT, but we don't have a separate list of documents to extract it from. We extract it from the same receipts and invoices we are already familiar with. The major difference is that VAT-related documents do indicate the VAT registration number for the business which charged the sales VAT. What is sales VAT to a seller, becomes purchases VAT to a buyer. Section 10.6. Recording sales VAT. Sales VAT is extracted from sales receipts and sales invoices, which indicate the net amount, the VAT amount, and the total of both, which is the gross amount. All transactions involving VAT require 3 entries when recording.
If it's a paid sale on a receipt with VAT, entry 1 is to credit the sales account with the net amount, entry 2 is to credit the sales VAT account with the VAT amount, and entry 3 is to debit the receiving account with the gross or total amount. Next is an illustration. Recording sales with VAT. First, credit the income account with the net amount, which is the sales takings account. Second, is also a credit entry for the VAT amount made on the sales VAT account. Third, and a debit entry made on the receiving account for the gross amount on either the cash account, check receipt account, bank account, or electronic receipt account. The debit entry is made on one of the 4 accounts, depending on which one received the money. An illustration of receipts with VAT. These receipts are recorded in the ledger as illustrated below. This slide has the 4 accounts illustrated. According to the double entry principle, each amount is recorded once in the credit column and once in the debit column, in the general ledger. That is still fulfilled here, because the amount of 42.96 is recorded as a total in the debit column on the check receipts account, and as 2 split figures in the credit column on the sales account 35.80 and the sales VAT account 7.16. When the 2 figures credited are summed up, we get the total of 42.96 that is debited. If the total debited is the same as the total credited, then the trial balance will balance. Hi, we thank you for your cooperation through the past slides. We hope you are gaining some knowledge in the process. Please remember to note down anything important or requires clarification. You may discuss with a colleague, an accountant, or a tutor nearby. Your next option is attending our free online tutorials, where you ask any questions. Your last resort is sending an email to admin@practicalaccounts.com. If you need to have a break, just press the pause button. Otherwise, we keep firing on all cylinders. All we need is your silence and undivided attention. We have more information to share with you. Thank you. Section 10.7. Modified Sales VAT Account. To simplify the process of generating a detailed VAT report, we modify the sales VAT account. All sales transactions required on the VAT report are recorded on the modified sales VAT account. Next is a summary VAT report. This VAT return has 9 boxes. Box 1 is for VAT due on all sales. Box 2 is for the VAT exempted on purchases from other EU states. Box 3 is for total VAT due, an addition of Box 1 and 2. Box 4 is for VAT reclaimed on purchases. Box 5 is for the net VAT to be paid or reclaimed. Box 6 is for the total value of sales excluding VAT. Box 7 is for the total value of purchases excluding VAT. Box 8 is for the total value of sales to EU excluding VAT. Box 9 is for the total value of EU purchases excluding VAT. This summary report is sent monthly or quarterly to the UK VAT Authority. The layout of this report in other countries is different, but we focus on this layout for standardization. The figures recorded on this report are a summary, but normally the VAT authorities need to see how they were calculated. Even if the detailed report is not sent as part of the summary, it's kept in the business for another 6 years. The VAT authorities may need to investigate before the 6 years elapse. So the detailed report has to be prepared in a way that is fairly self-explanatory, and then filed.
Before we come up with the totals for the summary report, we must have a detailed computation. That is what we refer to as the detailed sales VAT report. When using account software, we get it by just clicking a button. However, in order to generate it manually, we need to modify the sales VAT account as illustrated below. This slide has the modified sales VAT account, which also serves as the detailed VAT report. As transactions are recorded onto this modified account, a detailed VAT report is generated. No need for a special report, and this saves time. Therefore, we not only record the VAT amounts on the modified VAT account, we also record the net or gross values for all sales made. Just like any other account, the date, narrations, and doc number columns are used in the same way. The debit column is allocated to the recording of VAT amounts. The credit column is allocated to the recording of all net and gross amounts. This implies that if there is VAT on a source document, then we record them separately, both the net amount and VAT amount on the same account. If there is no VAT, then we only record the gross amount that excludes VAT. The balance column is allocated to the recording of sales values to EU buyers, excluding VAT. This figure is required for only statistical purposes, for calculating the total net value of sales made in the UK, to buyers coming from other EU countries like France and Germany. Since this course is international, EU transactions will be kept to a minimum. Since the balance column is utilized by EU sales, we can only get balances in form of totals at the bottom, after recording all transactions for the period. So the total 35.84 is recorded in box 1 on the VAT return illustrated on a previous slide. The 232.20 is recorded in box 6, and 24.20 is recorded in box 8. The aim of the sales VAT modification is to collect together all sales transactions required for the VAT report. We don't have to search the whole general ledger to identify what to include on a VAT return. There is more on this in Chapter 12. So from this point onwards, all sales end up on the sales VAT account, unless they are outside the scope of VAT. However, among the 3 entries made on the modified sales VAT account, it's only the entry for the VAT amount that is part of double entry. The other 2 entries are for amounts excluding VAT.
As far as double entry is concerned, they are already credited to the income accounts. It's a bit confusing at this stage, but we can master it after exercise 10C in the book. There should be some indication on the document to show that the sale was made to an EU customer. If there is no indication, then we assume it's a sale to a customer within the country, UK. If the document or transaction has VAT, then we record it in the VAT column, and if it doesn't, then we don't. However, for all transactions, we must record the amount excluding VAT, in the second column for box number 6. Recording a sales receipt using the modified sales VAT account is summarized below. Recording sales with the modified VAT account. First is a credit entry. For the net amount made on the sales takings account. The 2 is a credit entry on the sales VAT account, made with another 2 entries. The first is for the VAT amount totaled for box 1 on the VAT return. The second is for the net or gross amount totaled for box 6 on the VAT return. The third is for the EU excluding VAT amount totaled for box 8 on the VAT return. On the third account it's a debit entry, made on the receiving account. And this is for the gross amount, a sum of both the VAT and the net amount. Depending on how the sale was made, it's debited to either the cash account, check receipts account, or electronic receipts account. At this stage, try exercise 10C in your books. Other receipts. This refers to money received that is not income. This includes capital introduced, borrowed money, a fixed asset sale, a purchaser's refund, debtor payment, or other type of receipt. A fixed asset sale is not an income, since it was not bought for resale. For all received money, a receipt should be written to confirm, and it serves as the source document. An illustration next.
This slide shows the different types of income, plus the other. Section 10.8. Fixed assets sold. If a fixed asset is sold, then a copy of the issued receipt is the source document. We record this by crediting the fixed assets disposal account with the net amount, crediting the sales VAT account with the VAT amount if VAT was charged, and debiting the receiving account. We have to be clear of the account which received the sales money. Next is an illustration of the possible double entry. The recording for fixed assets sold. The first is a credit entry for the net amount, made on the disposal account. The second is a credit entry on the sales VAT account, made with another two entries. The first is for the VAT amount, totaled for box 1 on the VAT return. The second is for the net or gross amount, totaled for box 6 on the VAT return. The third is for the EU excluding VAT amount, totaled for box 8 on the VAT return. On the third account it's a debit entry, made on the receiving account. And this is for the gross amount, a sum of both the VAT and the net amount. Depending on how the sale was made, it's debited to either the cash account, check receipts account, or electronic receipts account. At this stage, try exercise 10D in your books. Section 10.9. Refund received. A business pays when it buys something. However, if the bought item is taken back to the seller, then the business receives a refund. If that was paid as part of the buying price, then it's recovered as part of the gross amount, as a purchaser's VAT refund. Next is an illustration of the possible entries when recording a refund received.
The recording for a refund received. The first is a credit entry for the net or gross amount, made on either an expense account or fixed assets cost account, depending on what was bought. The second is a credit entry, but the amounts have to be negatives on the purchaser's VAT account, made with another 3 entries. The first is for the EU VAT that was not paid, totaled for box 2 on the VAT return. The second is for the VAT amount, totaled for box 4 on the VAT return. The third is for the net or gross amount, totaled for box 7 on the VAT return. The fourth is for the EU excluding VAT amount, totaled for box 9 on the VAT return. On the third account it's a debit entry, made on the receiving account. And this is for the gross amount. Depending on how the refund is received, it's debited to either the cash account, check receipts account, or electronic receipts account. Recording a refund received is a process of reversing the recording for the initial purchase. The first is a credit entry for the net or gross amount on the expense or a fixed asset account, where it was initially recorded. The second entry should be a debit, but because of the modification, the figures are recorded as negatives on the purchaser's VAT account, in the columns they were originally recorded. It's the addition of negatives to positives that reverses the values recorded initially. The third is a debit entry for the gross amount, made on the account which received the money. Next is an illustration of a recorded refund on the purchaser's VAT account. This slide shows a recorded refund on the purchaser's VAT account. the previous purchase is reduced to a zero when the refund is recorded. We have more on the modified purchases VAT account in Chapter 11 and 12. Section 10.10. Capital introduced. This is money brought into the business by the owner during the financial year. There is no VAT on this since there is no sale or value added. If it's a check received from the owner, then we record it by crediting the capital added account and debiting the check receipts account. When capital is received in cash form, a receipt should be written. This is recorded by crediting the capital added account and debiting the cash account. Next is an illustration of the possible double entry. Recording capital introduced. The account to be credited is the capital added account. We debit the receiving account, which is either the cash account or check receipts account. At this stage, try exercise 10 East in your books. Section 10.11. Borrowed money. Banks are the commonest source of borrowed money. There is no VAT on this since there is no sale or value added. If it's a loan, then the source document is the loan agreement. It indicates the amount borrowed, the interest, plus the monthly repayment amount. We record this by crediting the loan account and debiting the receiving account. The loan could be received in cash form, it could be transferred directly to the bank account, or it could be a check. Below is an illustration of the possible accounts for double entry.
Recording borrowed money. The credit entry is made on the account reserved for it, either Loan 1 account or Loan 2 account. If it was borrowed via the credit card, then we credit the credit card account. The debit entry is made on account which received the money. This could be the cash account, bank account, or check receipts account. Please note that different loans should be recorded on different accounts. That is why we have Loan 1 account and Loan 2 account. These accounts should be given a clear identity basing on the loan source. For example, the first one could be a Barclays loan and the second is a Stanbic loan. It's also possible to borrow from a credit card company and they send the money in form of a check. This check is initially recorded by debiting the check receipts account and crediting the credit card account. It's later transferred to the bank account using a deposit slip. If it's a loan from an individual, then there should be some form of agreement, which is recorded in the same way as the one from a bank. If there is no document, then it should first be recorded in the journal book before posting. Journals are explained in Chapter 14. At this stage, try exercise 10F in your books. Section 10.12. Agency collections. Agency collection refers to money received by a business, when it serves as an agent, by selling on behalf of another business. This is common with the selling of lotto tickets, and the mobile money business. What is sold should not be credited to the sales account but to the agency collection account, among the other current liabilities. If the sale was for lotto, then we have to specify on the receiving account. The debit entry is made on the account which received the money. Next is an illustration of the possible accounts for double entry.
Recording agency collections. Credit the agency account. It may be the National Lottery account or Southern Electricity account. Then debit the receiving account, depending on how it was received. This could be the cash account, bank account, or check receipts account. The business selling as an agent does not add VAT, since the price is set by the company they are selling for. However, the main company being sold for has to account for VAT in its records. As for the commission earned on each sale, it's recorded by debiting the agency account and crediting the commission income account. At this stage, try exercise 10G in your books. Section 10.13. Other receipts. This includes money received for anything else in the business, that is not income, not capital, not a purchaser's refund, not borrowed money, not agency collection, not a fixed asset sale, or a debtor payment. It could be a non-trade debtor that is paying a refund for a rent deposit, or something else.
When recording, we credit the account, where the money came from, or what it was received for. We debit the account which received the money. There is no VAT on these receipts, since they are not income. Please note, documents for income received, and those for other receipts, are normally stored on the same file, the Income and Receipts file. Section 10.14. Balancing accounts. Most accounts do receive and give away values. What remains after the receiving and giving away of values is what we call a balance. When a particular income is received, we credit its account, and when there is a refund against it, we debit the account. When an asset is bought, we debit its account, and when it's sold, we credit the account. The procedure for generating balances on accounts depends on the nature of the account. For incomes, liabilities, and capital, an entry in the debit column reduces the balance, while an entry in the credit column increases the balance. For expenses, assets, and drawings, an entry in the debit column increases the balance, while an entry in the credit column reduces the balance. One of the advantages of vertical accounts is being able to generate a balance after every amount recorded on an account. When generating a balance, we must utilize the figure on the row just above, as illustrated below. This slide has the cash account. It shows entries in the debit and credit columns, plus the balances calculated. It follows the balancing method for assets, expenses, and drawings.
If it's an expense, an asset, or a drawing, to the balance figure on the row above, we add the figure in the debit column, and subtract the figure in the credit column. Please note that we should not have figures in both the debit and credit columns on the same row. In the above illustration, it's 570 less 2.70, to get the 567.30. We add 435 to 567.30, to get a new balance of 1002.30. Please confirm the rest of the balancing calculations on the account. If it's an income, a liability, or capital, to the balance figure on the row above, we add the figure in the credit column, and subtract the figure in the debit column. Below is an illustration. This slide has the loan account. It shows entries in the debit and credit columns, plus the balances calculated. It follows the balancing method for incomes, liabilities, and capital. In this illustration, it's 6,499 add 50, to get the 6,549. We subtract 216 from 6,549, to get a new balance of 6,333. Please confirm the rest of the balancing calculations on the account. After getting to the end of this chapter, next is attempting the multiple choice questions at the chapter and in the textbook. Ensure the manual practice questions in the chapter are also done. If you don't have a book, please contact the Association of Practical Accounts by sending an email to admin@practicalaccounts.com.